Navigating the Investment Landscape. Now, that's going to be moderated by my colleague, Commissioner Scott White of Virginia, who is also the NAIC Vice President. As soon as we get our stage set up, our panel is going to feature Craig Swan, the Chief Executive Officer of the Bermuda Monetary Authority, Ken Johnson, Managing Director of AM Best, and Douglas Niemann, Executive Vice President and Chief Risk Officer of Athene Holdings Limited, as well as Pooja Rahman, Chief Risk Officer of Transamerica. So with that, Commissioner White, boy, we're darn close to getting you all set up, and the flowers are in place. There's water on the table, so it looks to me like you're up.
We've got a great group of panelists here. I'm very excited about the discussion we're going to have. Douglas and Craig and Ken and Pooja. And we're going to be focusing today on the investment behavior of insurance companies. And we're going to be focusing on life insurance companies. Obviously, this is a big topic. I was here last year talking about the same set of issues. Insurance is at the heart of every insurance operation. Insurers are some of the biggest players on the financial markets domestically and internationally. I know we have some of our friends at the Fed and Treasury are here and are focused on this issue, as well as, of course, internationally. Some of the things we're going to be talking about today are the subject of two special subjects as part of the IAIS GMAR. So there's a lot of interest around what's going on, and we hope to get enlightened with this distinguished group today. So I'm going to start right in. So it wasn't that long ago. It was a few years ago. We were hosting panels on the low for long environment, low interest rate environment. But as we all know, we're in a different situation here with a higher interest rate environment. We're going to dig into those issues as we move through the panel. But to begin, I really want to have the panelists give me an overview of the new, what we'll call new investing environment, right? And here I'm talking about the changing climate of interest rates, cooling if persistent inflation and fluctuating markets, and the trends they've had and what we've seen in terms of the shifts in insurer investment strategies and portfolios. I'm going to start with you, Pooja, and tell the audience how has your company been reacting to this changing landscape?
Thank you, Commissioner, and thanks for having me here. It's a new normal. It feels like a new normal. Nothing, things change. It's been said that the environment changes, but for me personally, it felt like low for long lasted a really long time. And so as much as I like to complain about the volatility that we're seeing, and could we have a new normal, and could it stabilize, it does feel good to be out of a very long period of time where the norm was inflation is low, rates are low, equity markets are going up. Yeah, it's all good. So it's a new normal. The playbook, the low for long playbook that we had for a very long time, and whether we like it or not, people get used to it. People get used to that environment. That's the way we operate. Has had to change. And so as we look, connecting that back to insurance and investments supporting insurance, the one question that anchors it for me is, what's your long-term play? What are your liabilities? Investments should always be liability anchored, so that hasn't changed. But perhaps a change from low for long, the second question that I always ask myself and others is, okay, what's the yield over risk-free? And are you seeing yield over risk-free, premium over risk-free in the same asset classes for the same amount of risk that you saw in the low for long environment? And that has changed. Any model that doesn't give you different answers is probably not a good model if it just keeps spitting out the same thing. So we are seeing input where that relative value from an investment perspective in this era, which is not a low for long era, which is a rising inflation era, rising rates era, has changed. And that's input we are taking in, evaluating and considering as we make investment decisions that continue to be liability anchored.
Very good. Why don't we get another company perspective with you, Doug, and
Sure.
With Athene.
Absolutely. Appreciate being here, and thanks for the question, Commissioner. I think I'd start off with the theme from this morning because I think it's affecting investment markets, all markets globally, and it's the retirement gap. The dependency ratio after World War II, 8 workers to every retiree, next couple of years, 3 to 1. 11,000 new retirees a day, probably close to a 3.7 trillion shortfall in that savings gap. And it was just published on the cover of the Wall Street Journal yesterday. Due to the inflationary environment, the retirees in the last 2 to 3 years, middle-income Americans actually saw a 14% reduction in that nest egg because the income they're earning on their assets is below the rate of inflation. And that's happening at the exact same time that there's been something of I guess I'd use the term tectonic shift in capital markets. Not too long ago, G20 finance ministers were saying that the economy globally needed north of $90 trillion of capital investment in infrastructure and to help fund the transition to the new economy. But during this same period of time, the number of publicly traded companies has shrunk from 8,000 to 4,000. At the same time, there's been tremendous concentration in the public markets. The Bloomberg Barclays aggregate index is comprised over 35% of financials. So we have financials buying financials. Likewise, the ratio of passive investments in fixed income securities relative to dealer inventory, I think many know, shrunk from something like 3 to 1 pre-GFC to well north of 30 to 1 today. And the story's not different in the equity capital markets. The S&P 500, let's call it roughly 80% of the capitalization. The top 10 names are 35% of that, and their PE ratio is 45. So if you're one of our customers and you're looking at that world, let alone myself and the colleagues in my office, with no landing, soft landing, hard landing, what is a person to do? And I think that helps to explain as well some of the shift that we've seen with the development of private markets that are helping to bring down the cost of financing for consumers and corporations, at the same time helping to bolster the rate of income for retirees that are facing that dire environment that I just talked about.
Very good, and I'm going to go to you now, Craig. Tell us what has been BMA's response from a supervisory and regulatory standpoint to this changing investment landscape.
Yeah. We've made changes in a number of areas, but to touch on 3 of those areas. The first thing we did was we made amendments to our risk-based capital model, the Bermuda solvency capital requirement. And what we did there, based upon what we're seeing and also what we are expecting, is one of the changes is that we enhanced the risk, the lapse and expense risk charges. We made them more risk sensitive. And we did that by moving from a factor-based approach to a shock-based approach. Another change that we made as a result of what we're seeing around in the climate is changes in governance, and particularly around our scenarios-based approach, which is the approach that we use in order to calculate reserves. So there in the governance, what we did was, it's important that we get credible figures and that companies are making the calculation as they should. So now we require an attestation by key officers whenever they are using that approach. And they have to sign off, as an example, the chief risk officer and the chief investment officer has to sign off on the investment assumptions that are going into creating the reserves. And then there's a number of amendments with respect to, or enhancements with respect to supervision and reporting. So it's more detailed reporting on investments and reserving. But in the area of supervision now, we require a number of approvals. So there's an approval that's required if one wants to use the SBA. There's approval that's required if one, for all block business that's transferred to Bermuda, that's really key. as well as approvals if wants to use unrated or non-public assets, publicly traded assets, to support liabilities. And we introduced very strict approval criteria around affiliated, related, as well as connected assets. And then we've done things such as, like, one fact about the Bermuda market that is probably not that well known, except with industry participants, is that for the most part, with the life transactions, the actual assets that are supporting liabilities remain under the control of the ceding company. And the ceding company also has veto power in terms of the composition of the collateral that's there. And so for us, it was important to interact more with regulators in order to share insights in terms of what we are doing. Our insights are more focused on AML, liquidity management, as well as the prudent person principle. So there's a number of changes that we've made as a result of this industry.
So these changes have gotten a lot of attention, and I think you did a very good job of describing those. Can you tell us what the impact they've been implemented, and what are you seeing now?
Yeah. Well, some of the changes were implemented. For example, the approval of all block business. That was implemented in January of 2023. And we've had a lot of interaction, obviously, with regulators, because the way that works is that we collect a lot of information around reserving assumptions, around the investment strategy, composition of the collateral, target, total asset requirements. And we share that information with other supervisors. And we get their insights with respect to how their experience with the block of business, that factors into our decisions. And what we found is that at times, because of that experience and the collaboration between regulators, we have to make adjustments to the total asset requirements or make other restrictions. But it's been quite a fruitful experience that we've had.
Very good. So let's turn to the perspective of the rating agencies, AM Best. How are they considering the changing landscape, both in terms of rating insurers and then the outlook of the industry more generally?
Yeah, maybe touch on a point, Craig, that you raised is the amount of information needed obviously has gone up considerably, especially due to the growth on the private side. So if I just take a step back, the information that we gather comes from three sources, right? We take it from the financial statements, and then we have what we call a summary questionnaire that goes out to all companies and that asks for some additional information, anywhere from distribution to PMLs on the property side, but also additional information on the investment side. And then thirdly, we get information from our annual meetings with insurance companies, where they'll have their CIO come in and talk to his portfolio. And I think what we try to do is not get so caught up on the individual assets, but more of an ALM approach. Do they understand what they're buying and what they're using it for? So I think we've tried to move more to a portfolio type of analysis when we talk to companies, and just make sure that they understand what they're buying. Especially, we've seen a proliferation of the use of third-party managers. It used to be maybe the small guys used one or two, the big guys never used any, but now even the small to mid-sized players are trying to act as a manager of managers with those asset managers, because everything has gotten so specialized. And even the larger guys are outsourcing stuff because they realize it's expensive to have the infrastructure to be so specialized in so many asset classes that are out there. But it really comes down to getting the information, look at the ALM aspects of what they're doing, and does it make sense given the liability and capital constraints.
Good. Well, we're gonna start focusing in on particular topics, and I kind of set the table at the beginning by talking about the change in the interest rate environment. And I want to spend a few minutes talking about that. I'm gonna start with you, Doug. What are some types of investments or strategies that have become more attractive in this new environment?
Yeah, I would say, especially at our firm, I think we've, developed a reputation for engaging in the private capital markets, if I could call it that, with, a much broader and more diverse set of collateral pools. We generally structure those so that they're consistent with the duration and cash flow profile of our liabilities. But importantly, the cash flows in those assets are closely linked to the real economy. And so they participate in economic growth and or inflation. It's a little cheeky, but you could say from ketchup to computer chips, airplanes to aluminum beer cans. And so really, as the economy continues to expand, and if there's an inflationary force, you can see this in rents as an example, that those cash flows actually inure into the structuring that we've done in those assets that then flow through directly to the products that we've sold to our customer base.
Very good. And Pooja, are there new risks that you're looking at, your company's looking at, that higher interest rates pose to insurers? And if that's the case, are there ways for those to be mitigated?
So the higher interest rate environment makes a lot of products more viable, makes the investments more attractive. What are the risks that it brings with it? I'll always start with know your liabilities and invest according to that. So, you start with what are the best assets I might have for a particular duration of liability, and then how certain am I? Nothing is 100% certain, but some liabilities are a lot more illiquid than others. So when I look at something like a term life policy, you look at the risk-adjusted return on some of the investments on the asset side that are available, they become a good match. If you've got something that's a little more deposit-like, a little more on the annuity side, just looking broadly in the industry, there have to be some boundaries around how much in terms of illiquid assets, if any, you put, what's the duration element of that, because again, the liabilities, term being an example of a largely illiquid liability, not correlated to markets, versus a more investment-like product that could have some level of correlation with markets. And you mentioned the higher interest rates, and that's where I'm going, where in a rising interest rate environment or an environment that has seen a lot of rise in rates, and we're also watching on whether you could see more of that, the liquidity of the liability becomes the primary key. The investments that you use to support liquid versus illiquid liabilities or less liquid liabilities, follow suit. And then finally, you all have allocations, certain limits around how much by way of illiquids, how much by way of a ALM mismatch you would allow within the asset classes themselves. Continue to watch the credit quality. We just heard about what's the cash flow supporting some of the structures, have the ability to not just look at what's coming through from the other side, but the ability to stress test those cash flows. Because your liabilities could be illiquid, but some of those cash flows could have some susceptibility to market environments based on where they're invested, or they could be completely uncorrelated. So those are the three levels of starting to know your liabilities, start with that and allocate based on that, and that's a general theme, but particularly in a rising rate environment, or one where we are looking at, what that might do, have that emphasis on what are the liabilities, so the sources supporting those liabilities. Final point that I think I haven't heard so far, but we hedge exposures, we hedge rates, we hedge, variable annuity books, market risk, liquidity ramifications, collateral impact, collateral considerations, cash management. Also takes a very key primary role in this type of environment where you've got to be very mindful of not just liabilities that could be coming due, which all of us would have different levels of that, but also if you happen to have a large derivatives book, the cash management around meeting that collateral need, and posting that collateral need is again something that becomes top of mind.
So Craig, you've heard Pooja and Doug talk about from the company perspective how they're looking at it in terms of their strategies and what they're thinking around. As a supervisor and monitoring the industry, are there things that you're looking out for?
Yes, obviously what they're talking about. But I also touch on maybe 4 areas. So one of those areas that we'll be looking at are surrender rates. And I know France has had some challenges. We have not seen mass surrenders. However, we have seen an uptick, particularly in those products that don't have surrender charges or that don't have mitigating riders. So that's one area that we're looking at. Another area we're looking at, somewhat touched on here, is margin calls, particularly for companies that use derivatives. But we don't have many, but certainly for those companies that do use them, it's an area that we're focused on. Another area is liquidity position. And so certainly we believe that illiquid assets, depending on, certainly for those liabilities that are long dated and illiquid, that illiquid assets can be used in an effective ALM program. But as Pooja said, things don't always work out as expected. And so what we've done, and one of the changes that I didn't mention or didn't focus on much, is around liquidity management and stress testing. And so what we do is we require companies to have a liquidity buffer above what they think their needs are. And then in the event that that liquidity buffer is exhausted, then they also should have identified a contingent source of liquidity. And then concurrently, what they need to do is they need to stress test their assets and liabilities, and they need to meet a liquidity coverage ratio. And for all of this, again, as we do appreciate the importance of illiquid assets in ALM, but in this case, illiquid assets cannot be used to satisfy these. They're viewed in our regime as unsellable. So, in looking at liquidity position, for us is emphasizing and being careful that a company has sufficient liquidity, not counting the illiquid assets. And the last area I would mention is the impact on business models. And so we've had a number of companies that, certainly the companies here have been around for a while, but we have had a number of companies that are set up in the low interest rate environment. They haven't been through the cycle. And so we're looking to see how they're responding to this new environment.
Very good. Now, Ken, anything to add in terms of what you are looking at in terms of the impact on the higher interest rate environment on insurers?
Yeah, maybe I'll pick up, where you left off as far as the liquidity. We've always run liquidity tests both on a short-term, long-term basis as sort of a standard analysis when we do our annual reviews with companies. Because you can certainly see the great financial crisis was probably more of a liquidity event than a capital event back then. So liquidity is pretty important, and you'll either see it within the portfolio, you'll see it at the parent that could be put down into the company if needed. And I think Sandra mentioned a little bit about the FHLB. They've been very aggressive in providing facilities for a lot of life and PC companies. So we do look for other sources under stress scenario where they can get that capital from. I'll look at the risk a little bit differently. One of the things that, private credit, the issuers represent 80% of the financing market. So I don't see how you can say you can't be in that asset class or that the asset class is a problem as a whole. But one of the things that do concern us is, the valuations are modeled, right? There's not a test against a public piece to look at. But secondly, the rise of the non-bank financial institutions and what their underwriting standards are versus what the banks may have been. There are some questions there. There's some very good ones, but there are others that are newer into the business, and we don't have a sort of a track record on how well they're underwriting those loans. So it could raise some concerns from that standpoint.
Good. So let's turn to a topic, again, that's gotten a lot of attention both at the NAIC and the IAIS, and that's the issue of the growing trend in alternative assets and also cross-border asset-intensive reinsurance. There's kind of a link there. But I think before we dive in, it's helpful to make sure we're all talking about the same thing. Who wants to tackle and just let the audience know, when we say alternative asset, what are we talking about here? Who wants to tackle that one?
I'll take a first shot at it, right? So I guess in the old days, it was primarily just private equity and hedge funds and real assets, right, which would include real estate. Or for those of you out there with the U.S., it was BA. Schedule BA generally is where you captured your alternatives. But now it seemed to have morphed into everything that's either not a treasury, a government, or a corporate investment-grade holding. So it's certainly been broadened, and the definition alone just on private credit is all over the map still at this point.
Very good. I'm going to go back to you, Doug. Give us an indication of how this changing landscape has affected insurers' demand for these alternative assets.
Yeah, I think, it's interesting, when rates were low, it was, it would make profitability on mortality margin, interest margin, et cetera, kind of squeezing with, those that didn't have, probably an operational profile, that they maybe had wished when those rates came down. But, with rates higher and in this environment, I think as Ken just intimated, where, 80% of the companies that have greater than $100 million of revenue are private, lots of reasons for CFOs and management teams to access private capital markets. And as I mentioned earlier, a real need for that. I think that more and more insurance companies have looked at, the profile of their liabilities, as Pooja has said, and said, unlike a bank, we don't necessarily need to be in the business of, liquidity and maturity transformation, but we can be in the business of credit transformation. As a result, we don't have to bear the, necessarily all of the expense burden of the other two. We lend long or borrow long, so we should lend long. And so I think it's created an opportunity for more and more companies to step, into the space, to be an intermediary. I think at the organization that I represent, one might, I don't want to kind of talk our own book, but one might argue that we had something of a first mover advantage. We've got 16 different platforms that act in that marketplace underwriting assets. So I think to Ken's point, it gives me great comfort in my role as the risk officer that we actually control that credit box. We control the collateral pools, how it's structured, the profile of those cash flows. So I think it is, I think the panel's highlighted two items that everyone should pay attention to is what is the liquidity profile of your own firm, right? And I think we saw this through COVID is that, the mark-to-market on some structured products can be quite wide. In that securitization, do you have wide-bodied or narrow-bodied aircraft, right? It depended on which airplanes were flying first. And then I think the second is the underwriting standards, the actual underwriting standards and how those assets would perform. I guess I'll highlight that, going into the great financial crisis, some buckets of structural products didn't do well, but many did very well, and very well relative to publicly traded corporates. And since the GFC, really no impairments in CLOs and ABS. So, but can't rest on the laurels. There's a lot of new entrants, and it's something that I think everybody should pay attention to.
And obviously, there's been a lot of attention over the last few years on the capital requirements for alternative assets, whether you're talking about private credit or alternative-backed securities, structured securities. Pooja, how do the capital requirements for these assets impact your decision-making when it comes to that?
Yep. No. So, capital can be regulatory capital. Capital could be your own internal capital model. But, at the end of the day, capital, if done right, it's never perfect, is a measure of risk. And as capital goes up, your risk-adjusted yield or your capital-adjusted yield would come down. And so, if you wanted to assess how popular you are, and if you happen to be in a job where you own the capital model of a company, try to see how businesses react the first time capital goes up. It doesn't mean it's wrong. It just means it has a very direct impact on, both in-force management. You stay, if there is an adverse situation on the book that you're holding, whether it's on the asset side or the liability side, your capital will go up. Well, that's just math, right? Either you're mismatched or, mortality is worse or credit environment has changed. Your capital will go up. Your free capital is lower. That shows up in the numbers, but that's how it flows through. When it's a true measure of risk, it's doing its job. As it relates to capital allocation, when the risk associated with investments, actual perceived, that's for you to assess, goes up, the risk-adjusted yield or the post-capital yield of an asset class goes down, and it may no longer be a preferred asset class as this company is trying to allocate dollars. So what you want is, obviously, we all want the highest amount of yield with the lowest amount of risk, keeping everything balanced and still not having too many concentrations of a good thing, even if it looks like a good thing. But as capital has gone up, presumably from a real or actual, assessment of risk going up, what insurers stand to make, or what asset managers supporting these insurers stand to make from these investments can come down if the net yield hasn't gone up overall. And so appropriate capital measures, not always low, not always high, appropriate capital measures are extremely relevant to strategic asset allocation decisions, whether that capital measure happens to be regulatory capital or your own internal capital model, which is how you may be managing your firm. So as we've talked, linking it back to where this conversation has been, as we've heard conversations about whether capital requirements around some asset classes are or are not appropriate, that does matter as companies make investment decisions and allocate dollars into one asset class versus another. You want those numbers to be right, and you want to put in dollars where you're getting the best yield for that amount of risk taken. So there is a lot of emphasis across the globe, presumably, on what's the right capital measure, whether it's within the RBC system or whether it's in one of the global capital systems we tend to talk about.
Yeah, I was going to say it's certainly very important from the credit rating agency side, right? People have two views right now. We're either in this area where people are maybe a little overconfident in a soft landing, right? So they're in that risk-on approach. And then there are others that maybe they're underestimating the geopolitical issues that are out there right now, right? But for the most part, I think we're seeing a risk-on approach, and those companies with capital are moving ahead, right? It's probably less of a concern for them. Not that it's not a concern, but it's not a real constraint. Whereas some of the smaller, mid-sized guys, they can't do it directly, so they're trying to curb their enthusiasm, but they want to be in it, right? So what they end up doing is working with a lot of capital providers who have, we see a lot of insurance solution groups popping up, and some of them are very good and been in a long time, but other ones are very nascent. And their job is to find capital-friendly approaches to getting those assets on the books, right? And a couple of years ago, we created an internal investment working group, and it was to help analysts take a look at things that were, at the time, BA, and how to look through and get to the right capital charge. And we find that group's been extremely busy. I'm a member of that group, but we're seeing a lot more structures and ways to try to get around the capital charge.
So, Craig, in this changing environment we've been talking about and resulting shift in insurance company portfolios, do you see any areas as regulators that we should be reconsidering?
Yeah, certainly. I just had a little a flashback. This is a young audience, a fairly young audience, and so you might not know what I'm talking about. But when my son was born, we had camcorders. I don't know if you remember camcorders. So it was like this big projector that you had put on your shoulders, and it had a VHS tape, and it was a lot of footage that I was recording as he, as he was a child. Let's fast forward just 10 years later, and I was cleaning out the attic and I found this VHS tape. And I said to my son, "This is a lot of footage on this tape." And he looked at it, and by the way, the tapes were like the size of this book and maybe 3 times the thickness, right? So he took it and he looked, like puzzled, one side, turned it over, and then he said, "What you do with it?" In other words, how do you get the video out, right? And it dawned on me that in just 10 years' time, technology had moved on, and he had never used a video player. And as technology evolves, we have to evolve. But likewise, as the financial sector evolves, and as regulators, we also need to do the same thing. We can't be still with our VHS players. So some of the things that I believe that regulators must be reconsidering, particularly with respect to the topic that we're talking about, would be capital charges on certain assets, and including certain structured assets. And the reason I say that is that many regulatory regimes were calibrated at a time when these assets were not core parts of an investment portfolio. So there may not have been the data or the characteristics of the asset has evolved. So certainly that would be one area. Another area I think that regulators should be reconsidering would be minimum criteria for officers and key persons. Because essentially, as in this more complex environment with more complex business models, assets, et cetera, we have to ensure that our criteria for certainly senior management, the board, and active shareholders, that keeps step so that they continue to be sufficiently skilled to act in the best interest of policyholders. And then just listening here, a final point that I want to make, or a final area I want to focus on, is the depth of supervision. That's really key because, for example, there were a lot of changes, structural changes and reforms that were made after the financial crisis. But we didn't get to experience them, or it's arguably whether or not we got to experience them, because immediately central banks started to print money. And now that the printing machine has stopped, now we're starting to see certain things. And so I know there were a few points that were alluded to by my colleagues up here. For example, once upon a time, we could make general comments such as highly rated, publicly traded bonds and sovereigns are safe. So we can make that statement. Yet, some believe that the corporate bond market is becoming less liquid. I think it was someone from your parent company basically said that outside of the top 20, publicly it will take like 5 days to trade a publicly rated bond outside of the top 20. And even if that's not true, we saw the impact of the gilt crisis, a safe asset where persons felt that they would be able to trade at market or near market AAA and AA securities. And so we as supervisors have to reevaluate or reconsider some of the assumptions we're making as to what's safe or what's not. Another point would be, for example, certainly U.S. Treasuries are safe, but if I had a long-dated liability where it extended well beyond the maturity of Treasuries, and I'm loaded up on Treasuries to fit this liability profile, then is it possible for me to proper asset liability management? Or am I creating the interest rate risk for myself? And so, there are a number of things like that. Certainly we find that non-traditional assets are normally non-standard, which means that one could, if a supervisor is just taking a casual look, then they would miss the fact that essentially there's a wide variety that they're putting in one particular asset class. And so these need a tailored approach. And so I believe that what needs to be reconsidered is the depth of supervision. And you can't do that with generalists. You have to resource regulatory bodies with the appropriate skill sets in assets, liabilities, ALM, and governance in order to effectively regulate entities in this environment.
Very good. So why don't we extend this discussion a little bit by moving into the realm of reinsurance? And Ken, you did such a good job of defining alternative assets. I'm going to ask you to take a stab at when we talk about cross-border asset-intensive reinsurance. What do we mean by that? And can you give some examples?
Yeah, I guess the short answer is where the reliance is really on the performance of the asset, more so than the reinsurance and the liability side of the book, right? And we've seen, as Craig has mentioned, a large growth there of companies setting up, whether they've done it de novo, or whether they've bought a shell, or they've purchased a company. But and the supply is there. There's a lot of annuity business in force. The new business flows are very high. Was touched on a little earlier today, right? For two reasons. One is the crediting rate you can offer is higher now, and I think the customer education is up significantly. So it's very hot. The cedent wants to get these off their books for a couple of reasons, right? They can redeploy some of that capital. It can help them manage their earnings a little bit, and it really sort of moves a spread compression issue off of their books onto the reinsurer, right? And the reinsurer just loves it because they want the assets to invest, and especially if they're owned by an asset manager. I think what we see is, and the other thing is they're usually co-insurance. In the old days, Craig, you know this, right? Co-insurance meant you had a highly credit asset that was very liquid, and you could tell what the market price was, right? So we've certainly shifted from there with this business. And maybe to give a little kudos to Doug and his company, right? They were one of the forefronts of this, and they actually do a very good job with that, right? Where we've had other companies, maybe smaller companies, where that private credit started to move too much towards the affiliated side, right? And some of that gets lost if there's not enough transparency, depending on where the regime is. Okay, good. And I'm going to turn to you now, Pooja. Can you give us your view of some of the drivers behind the growth in this asset-intensive reinsurance, and how do you evaluate the appropriateness of investment portfolios with these liquid assets?
So starting with the definition that you just asked, I always look at, okay, you're going to reinsure liabilities at the end of the day, and then they're asset intensive if they carry a lot of assets with them. That was my simple way of figuring out what is asset intensive versus not. And behind that is obviously the structure where as you very appropriately mentioned, the performance of the overall product and the business is driven, a little more from the asset side and managing the asset side versus the more traditional insurance pooling that happens on the liability side. So that was sort of my way of looking at it. What would be, my thinking on an appropriate investment approach to these liabilities? It would be true to whether they were ceded or not at the end of the day. I think the fact that one insurer cedes it to another insurer, if you leave alone the fact that they could be in different jurisdictions, that's not, for this panel, but they're still insurance liabilities, there's still assets backing insurance liabilities, you still need the same rules, from an internal perspective. If this was an internal risk officer on this side of the fence versus this side of the fence, you're still managing your assets, you're still managing your liabilities. You mentioned sovereign debt. Sovereigns from my perspective have near zero credit risk. but they're absolutely game for market risk because the duration element and the ALM element could be mismatched. So from my perspective, if you're looking at it internally on an economic basis, how would you manage this book? It would be leveraging the strengths you have. So perhaps once it gets seeded, you have an owner, right? You have a book being managed by someone who has capabilities or competitive advantages on one side versus the other, has perhaps more asset-based capabilities to bring to the table, but in terms of the risk lens, all the rules still apply. Duration management, ALM, credit concentration. Too much of a good thing is a bad thing, right? Are you so concentrated that if one asset class or one industry goes down, it's taking this entire book down with them? That answer has to be no, right? I don't care how good you are at that. That answer has to be no. And so all the rules of game that apply when you've got it, within a seeding insurer's book still apply when they get reinsured, but perhaps there are capabilities that a reinsurer brings to the table, either on the asset side or on the liability side. You've got reinsurers that have large liability books that they're pooling across a larger market than perhaps the seeding insurer can. Those averages matter, those capabilities matter in being able to bring that to the forefront. But the rules of ALM, the rules of credit risk concentration, the rules of keeping your eyes open, the rules of limits around everything, would still apply.
Great. Now, before we leave this topic, I know this is a core strategy with Athene, and so I want to give Doug you a chance to give your perspective. And we've got some really good questions up here, and I'm going to add to that one that's direct to you around private credit, again, something that's also you spent some time talking about, and maybe you can address both of those. Is private credit inherently riskier than its public counterpart? And what is the empirical evidence from an actual default perspective? So why don't you start if you have anything to add on the reinsurance side, and then tackle that easy question.
Sure. On the reinsurance side, I'll maybe just touch on something Craig said earlier in the context of the nature of those relationships. The assets, usually stay on the cedent's balance sheet, and more often than not, that cedent's in the United States. And implied in that, with the growth of these relationships, reinsurance treaties, and with our firm, Bermuda in particular, it often is a question around, what's happening in Bermuda, and honestly, with Bermuda and the BMA in particular, there's a lot of attributes to the regulatory regime that aren't talked about: speed of execution, expertise, et cetera. Our organization generally has been known as being countercyclical, and when markets dislocate, those attributes I just talked about matter a great deal. I would also say this, just as a reminder, over the last 10 plus years, north of 80% of the capital in the life and retirement industry has been returned to shareholders through dividends and share buybacks. So, as a company in this space with the retirement gap, that we've been talking about, and I would presume from all of our regulatory colleagues, that's not really a happy development. But within our organization itself, we've brought $17 billion of private capital into the industry through Bermuda, and a lot of that has to do with the fact that we're attracting international capital that doesn't necessarily or didn't necessarily want to be exposed to the United States tax regime. Bermuda obviously has a corporate income tax. There's the base erosion and profit sharing regime that's come out. But I'd highlight those aspects, because often when questions are asked about those reinsurance relationships, there's kind of an implied question about what's happening in Bermuda.
Right.
Empirical evidence on private credit, versus public credit. I guess we all know from our own investment portfolios how did it work out during COVID? How did it work out when Russia invaded Ukraine? Was it fun trying to liquidate your bond portfolio in the midst of SVB? As I highlighted earlier, since the GFC, zero impairments in investment grade CLOs and ABS. And maybe I'll just highlight an example of what I'm talking about. I'll take one of our platforms called Wheels. which provides mission-critical automobiles, fleet leasing to corporations. And just as an example, it might be a pharmaceutical company with pharmaceutical salespeople, and it might be a property casualty company with a series of claims adjusters. It takes an event in the marketplace where both of those companies get impaired. And by the way, 98 others. And then in addition to having impairment in those leases affecting the cash flows, there's the secondary trigger of the actual collateral itself. And these leases generally have accelerated depreciation clauses, which means that, should we need to step in and liquidate the collateral, a very low likelihood that the market value of those assets are below the residual value in the contract. And then on top of that, push it through the securitization structure itself, which is a closed system, which includes the diversification I mentioned, but the structural protections that, redivert all of the cash flows through time to provide extra cushion in the inherent credit enhancement from the subordination in the structure itself. So you're looking at multiple contingent probabilities that have to occur for an investment grade tranche in a securitization to actually have an impairment, which leads to the empirical results that folks can look at, over at least even the recent history I just mentioned.
Great. I'm going to stick with these questions because I think they're good ones. And I'm going to ask Pooja your views on the impact in the current regulatory environment. What impact does that have on investment decisions?
So from a technical participant perspective, my hope is, we get it right? So that's, as someone who's part of the industry, again, very neutral lens, you want regulation to be right-sized and to fit. And so to the extent some things have to change, they have to change. We're open to a conducive process in that regard. I think linking it back to the investment decisions, if capital requirements change, that has an impact, as I mentioned earlier, on what's the post-capital yield an investment can bring. We're in this, most insurance investors are long-term investors. We don't change our approaches, quarter to quarter. We invest in certain asset classes. We learn about them. We build our knowledge base on that. We use it for backing liability. So we don't expect things to change dramatically. But again, if there are, appropriate or inappropriate, that could be your view, changes to capital, that does have an impact on how much insurers can think about using, a particular asset class, for example, as a preferred asset class. It does have implications on financials. It does have implications on future investment approaches, our strategic asset allocation.
Very good. So Craig, this question, sets the table by mentioning, I think accurately, the level of transparency the NAIC provides into insurer investment holdings. And the question posed is whether the BMA plans to enhance the public transparency of its insurer investments.
Yeah. One of the things that I would say, first of all, to set the table, is that the BMA is extremely transparent with regulators via supervisory colleges, via bilaterals, and as I mentioned, every block transaction involves the cedent regulator, and we don't approve block transactions if the cedent regulator has a concern. We just made, over the last year, significant enhancements to our regime. The rules came into play on the 31st of March, 2024. So the ink is just drying. So our immediate focus now is to ensure that this raft of changes is embedded within the insurance sector. And then beyond that, after that's done, we'll start looking at areas like this.
Great. So we do want to spend at least a couple minutes on trying to think a little bit about what we may be talking about in the future, maybe next year, in the coming years. What are, and I'll give this to you, Ken, what are some of the new trends in investment that we should be looking out for? Do you have any thoughts on that?
Yeah, maybe just a couple things. One is, I'll stick with our private credit topic, right? A lot of what's been going on has been in the direct lending area. I think what we're going to see is a lot more now morph into the what's called specialty credit. So whether that's situational, M&A, spin-off type bar lending, or true structured, right? Where we move away from some of the true, tried and true RMBS, CMBS, credit cards, et cetera, and you start to see more things like data centers and royalties, although royalties not really new, but more esoteric assets as collateral against some of these secured transactions. I think we'll see more use of AI. We haven't really talked about what was a favorite topic for a lot last year. But right now it's used just to basically augment decisions and maybe do some data mining. But I think it'll get a little deeper into this decision-making process probably sooner than we expect from that standpoint. And I think we will continue to see this specialization on the asset management front, and have more companies do that manager of manager type of approach to their portfolios, looking to the extent it doesn't get too expensive to work with who's experts in particular areas. Right.
So Craig, another easy question for you. Oftentimes we understand there's a number of different reasons for insurers to cede their liabilities off to jurisdictions like Bermuda, and sometimes they talk about the more favorable treatment with respect to reserving and capital requirements, how do you respond to that? That's a core strategy of these companies, and the appropriateness of that?
Yeah. Sometimes this is looked upon as, many say arbitrage, things like that, right? There's actually an advantage. What some companies actually want to do is they want to take business from across the globe and put it into one platform. And oftentimes that yields sufficient benefits because basically you get to diversify your risk. So we see a lot of that happening in Bermuda. Some people look at reserves. And when you look at reserves by themselves, it's actually only part of the picture. It's almost like, for example, all of us have pies. But what we did was we put a slice of that pie in another room. And the pies are different sizes. And then someone comes in, sees the slice of pie, and as a result of them being different sizes, they make judgment as to what the total asset requirements are. And essentially, with the changes that we've made, and as I said, we're approving all block businesses, we're not seeing the differentials in the pie. A lot of it, I think Doug mentioned some of it being speed to market. There's another question there that talks about the knowledge of the regulator in terms of what we are doing. And certainly, what companies appreciate about the BMA is the expertise that we have staffed up with. So we have asset specialists, we have model specialists, we have a lot of individuals that companies can have very in-depth conversations about, and then come up with pragmatic solutions in order to facilitate the business solution that they're trying to implement.
Very good. Doug, I'm going to ask you, we've talked a lot about private credit, and obviously some things that are brought up are it not being quite as transparent, and the use of private ratings that create concerns. How would you respond to the argument that additional safeguards might be needed to make sure regulators are more comfortable that these assets are appropriately valued?
Yeah, I think, disclosure always helps, right? I would like to hope that our organization is known as, being one of the most forthright in disclosure. We try to publish a lot of analysis and information publicly on our website or otherwise. I think the questions around, valuations of private assets are appropriate. We have very stringent valuation processes within our organization. obviously roles of auditors there. But I would say this too, kind of in the spirit earlier of what's an alt. Is it just an attribute, or more recently, actually, it turns out it's a set of attributes. And private can be safe and risky, just like public can be safe and risky. The legal form through which you access the economic risk, the valuation, the amount of disclosure, how deep the market is. And, should I say that some broadly syndicated loans have more or less disclosure than the municipal bond market? The municipal bond market is hugely complicated in the context of trying to understand the finances, yet 40% of that $4 trillion market is held by households. So, I think the aspiration is to continue to provide transparency and information in the context of how these assets are valued. And I would say, as we continue, just like has happened with private equity and private equity secondaries, or even to a certain extent the development with hedge funds and replication strategies, is that I firmly believe that as the marketplace continues to grow, secondary markets in many of these assets will continue to expand. The corollary to the comment earlier is we can sell a private asset in 5 days too. So, and some of those private assets, just like public assets, are difficult to sell depending on the market environment at the time.
Thank you. Well, we're out of time, and this has been a great discussion. I want to thank Doug and Craig and Ken and Pooja for your perspectives and your informed views, and it's been a delight to talk with you today. Thank you.
Yeah, thank you.
Great, thank you, Commissioner.